Hello everyone. Well, Friday's employment data was really great. The 195,000 gain in non-farm payrolls and strong upward revision to prior months put the average monthly payroll gain just above 200,000 in the first half. This was the level that various Fed officials had said would show that the labor market had improved enough to begin tapering off quantitative easing. The figures therefore cemented expectations that the Fed's going to start tapering off in September. That sent Treasury yields higher, but fortunately it also sent stocks higher too, because the figures showed that the labor market's recovering and therefore the economy is relatively strong. However, the markets ignored all the recent guidance by Fed speakers that quantitative easing and interest rate policy are separate issues and repriced the Fed rate outlook to assume that the Fed starts hiking rates by the end of 2014. That's well before the mid-2015 or later time frame that Chairman Bernanke had indicated. The result of these higher interest rate expectations was general strength in the dollar all around. Now, I'd expect the strength to be maintained. Look at the other central banks. The ECB and the Bank of England just started experimenting with forward guidance, a new form of extraordinary monetary policy. The Bank of Japan is only 4 months into the biggest QE program yet. The Reserve Bank of Australia is likely to cut rates further, and the Swiss National Bank is intervening massively to keep its currency from appreciating, which in effect is a form of loosening monetary policy. Only in some of the emerging market countries where inflation is starting to be a problem might the central banks consider tightening. But as U.S. interest rates rise, their yield advantage dissipates, which is likely to weaken the currencies, and they have to worry about tightening so much that they choke off growth. Putting this all together, the dollar seems likely to continue its gains, in my view. As for today's market, there's really only second-tier data out, so everything's trading basically off of technicals. For Eurodollar, it's noticeable that it was trading lower even before the U.S. data came out on Friday, and since then it's been clobbered, although it's higher versus the yen and sterling, which were clobbered even more. The euro's recovered a little bit today, but not even half of its losses from Friday. Support for Eurodollar came at the Head and Shoulders neckline at 128.05. The rebound is likely to be met with strong tested and trendline resistance in the 128.55 to 60 area. A breakdown of the neckline sees some support in the 127.50 to 65 area, with further support at 127.05. For this week, I think we could test 126.80. which is the 61.8% retracement level of the July 2012, February 2013 rally, or 126.60, the one-year low that was tested in November of 2012. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.